Diving into derivatives. What are they? Let's talk about financial derivatives. Sound complicated? Don't worry, they're not as scary as they sound. A derivative is simply a financial contract. Its value is derived from an underlying asset like a stock, bond, or commodity. Think of it like betting on the price of coffee without actually buying beans. There are many types of derivatives. You've got stock options, currency forwards, and oil futures, just to name a few. These tools can be your best friend or worst enemy depending on how well you understand them. So buckle up! We're about to demystify the world of derivatives and give you the knowledge to navigate them like a pro.
Derivatives can be used for many things. One of the most common uses is hedging. Think of hedging like buying insurance for your investments. Let's say you own a house. You buy insurance to protect yourself from the risk of fire or damage. Hedging with derivatives is similar. Imagine you're a farmer and you're worried about the price of corn going down. You can use derivatives to lock in a price for your future corn harvest. This way, you're protected from a potential loss. Hedging is a way to manage risk. It's like wearing a financial seatbelt. It won't prevent all accidents, but it can certainly soften the blow.
Now, not everyone uses derivatives for hedging. Some people use them to speculate on future price movements. These are your risk takers, your speculators. Speculators are like gamblers. They're betting on whether the price of an asset will go up or down. If they're right, they can make a lot of money, but if they're wrong, they can lose big time.
Then there are arbitrageurs. These savvy players profit from price differences in different markets. They buy low and sell high, exploiting inefficiencies for a profit. Remember, derivatives can be risky business. It's crucial to understand the risks involved before you jump in.
Well, Section 4, the derivative family options, forwards, futures, and swaps. In this section, we will delve into the fascinating world of financial derivatives, which are complex financial instruments used for various purposes, including hedging risks, speculating on future price movements, and enhancing investment returns. Let's meet the main players in the derivatives world. These instruments are essential tools in modern finance, and understanding them can provide valuable insights into how markets operate and how investors manage risk. First up, we have options. Options are versatile financial instruments that can be used in various strategies to achieve different investment goals. An option gives the buyer the right but not the obligation to buy or sell an asset at a specific price on or before a certain date. This flexibility makes options a powerful tool for both hedging and speculation. Think of it like putting a down payment on a car. You secure the right to purchase the car at a later date, but you are not obligated to follow through if you change your mind or if circumstances change. You have the option to buy it later, but you don't have to. This optionality provides a level of flexibility that can be very valuable in uncertain market conditions. Next, we have forward contracts. Forward contracts are customized agreements between two parties to buy or sell an asset at a specific price on a future date. These are agreements to buy or sell an asset at a specific price on a future date. Forwards are often used by businesses to lock in prices for commodities or currencies, helping them manage future costs and revenues. Unlike options, forwards are binding agreements. This means that both parties are obligated to fulfill the terms of the contract, regardless of how market conditions change. Futures contracts are similar to forwards, but they're standardized and traded on exchanges. This standardization and exchange trading provide greater liquidity and reduce counterparty risk. They're often used for commodities like oil and gold. Futures contracts allow investors to speculate on the future prices of these commodities or to hedge against price fluctuations. Lastly, we have swaps. Swaps are agreements to exchange one stream of cash flows for another. They are often used to manage interest rate risk or to exchange different types of financial instruments. For instance, a company might use a swap to switch from a variable interest rate to a fixed interest rate. This can help stabilize cash flows and reduce the uncertainty associated with fluctuating interest rates. Swaps can also be used to exchange different currencies or to manage other financial risks.
Section 5. Unlocking options, calls and puts explained. Welcome to this comprehensive guide where we will break down the essentials of call and put options, two fundamental components in the world of options trading. Let's dive deeper into the world of options. Options are financial instruments that give you the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified time frame. They are versatile tools that can be used for hedging, speculation, or increasing leverage. There are two main types: call options and put options. Understanding these two types is crucial for anyone looking to navigate the options market effectively. A call option gives you the right to buy an asset at a specific price, known as the strike price, by a specific date, which is the expiration date. This means you can purchase the asset at the strike price regardless of its current market value, as long as the option hasn't expired. You'd buy a call option if you think the price of the underlying asset will go up. This strategy allows you to capitalize on the asset's potential increase in value without having to pay the full price up front. Think of it like this. You buy a call option for Apple stock with a strike price of $200. This means you have the right to buy Apple stock at $200 per share, no matter how high the market price goes. If the price of Apple goes up to $250 before the option expires, you can exercise your option and buy Apple at $200, making a tidy profit. The difference between the market price and the strike price, minus the cost of the option, is your profit. A put option, on the other hand, gives you the right to sell an asset at a specific price by a specific date. This can be particularly useful if you anticipate a decline in the asset's value. You'd buy a put option if you think the price of the underlying asset will go down. This strategy allows you to lock in a selling price, protecting yourself from potential losses if the market moves against you. Imagine you buy a put option for Tesla stock with a strike price of $1,000. This means you have the right to sell Tesla stock at $1,000 per share, regardless of how low the market price drops. If Tesla's price drops to $800 before the expiration date, you can exercise your option and sell Tesla at $1,000, protecting yourself from the loss. The difference between the strike price and the market price, minus the cost of the option, represents your profit or the amount of loss you avoided. Both call and put options can be powerful tools in your investment strategy. They offer flexibility and can be tailored to fit various market conditions and investment goals. However, it's important to understand the risks involved, as options trading can be complex and may not be suitable for all investors. Before diving into options trading, it's crucial to do your research and possibly consult with a financial advisor to ensure you fully understand how these instruments work and how they can fit into your overall investment strategy. With the right knowledge and approach, options can be a valuable addition to your financial toolkit. In summary, call options give you the right to buy an asset at a predetermined price, while put options give you the right to sell an asset at a predetermined price. Both can be used to hedge against market movements or to speculate on future price changes. By mastering these concepts, you can unlock new opportunities in the financial markets. Thank you for watching this detailed explanation of calls and puts. We hope you found it informative and helpful. For more financial insights and strategies, don't forget to subscribe to our channel and stay tuned for our next video. Until next time, happy trading!
Section 6, Black-Scholes model, a peek into option pricing. Now, how do we determine the price of an option? That's where the Black-Scholes model comes in. It's a mathematical formula used to price options, taking into account factors like the current price of the underlying asset, the strike price, time to expiration, volatility, and interest rates. Don't worry, you don't need to be a math whiz to understand this. Just know that the Black-Scholes model helps us understand what makes an option's price go up or down. Think of it like baking a cake. The Black-Scholes model is like the recipe, and the different factors are like the ingredients. By adjusting the ingredients, we can change the taste and texture of the cake, or in this case, the price of the option. Section 7, the call option breakdown. Factors affecting its value. In this section, we will delve into the various elements that play a crucial role in determining the value of a call option. Understanding these factors is essential for anyone looking to navigate the complex world of options trading. Let's focus on call options for a moment. Call options give the holder the right, but not the obligation, to buy an underlying asset at a specified price within a certain time frame. This unique characteristic makes them a powerful tool in the financial markets. Several factors influence their price. These factors can be broadly categorized into four main areas: the current price of the underlying asset, the strike price, the time to expiration, and the volatility of the underlying asset. First, the current price of the underlying asset. This is perhaps the most straightforward factor. The value of a call option is directly influenced by the price of the asset it is based on. The higher the current price, the more expensive the call option will be. This is because the option gives the holder the right to buy the asset at a predetermined price, which becomes more valuable as the market price increases. Second, the strike price. The lower the strike price, the more expensive the call option. This is because a lower strike price means the holder can buy the asset at a cheaper rate, which is more advantageous. Think about it. The right to buy something at a lower price is more valuable. Third, time to expiration. The amount of time left until the option expires significantly impacts its value. The more time until the option expires, the more expensive it will be. This is because a longer time frame provides more opportunities for the underlying asset's price to move in a favorable direction. More time equals more opportunity for the asset price to move in your favor. And lastly, volatility. Volatility refers to the degree of variation in the price of the underlying asset over time. The more volatile the underlying asset, the more expensive the option. This is because higher volatility increases the likelihood of significant price movements, which can be beneficial for the option holder. Volatility is like the spice of the derivatives world, adding an extra layer of risk and reward. It can make options trading more exciting, but also more unpredictable. Understanding these factors can help traders make more informed decisions and better manage their investment strategies.